$47 trillion. That's not a typo. That's the total debt the Federal Reserve just quietly backstopped in the last 18 months. It was just absorbed into a system already drowning in obligations. You know what happened the last time the Fed did something this reckless? 2020. They printed $4 trillion in just 8 weeks. And what did silver do? It shot up from $12 an ounce to $30. That's a 150% jump in only 5 months. But here's what almost nobody's talking about. Let's rewind. March 2023. 3 major banks collapse in 72 hours. Silicon Valley Bank, Signature Bank. First Republic was on the brink. The Fed panicked. They announced something called the Bank Term Funding Program, which is just a fancy way of saying unlimited money for any bank that needs it, no questions asked. Fast forward to November 2024. Commercial real estate defaults are hitting 23-year highs. Regional banks are sitting on $1.2 trillion in loans that are completely underwater. So what does the Fed do? They quietly extend the emergency lending. Again. Then, in February 2025, Japan sells $63 billion in U.S. treasuries, the largest single-month dump in history. China follows, selling $49 billion. Foreign buyers are sprinting for the exits. The Fed's response? Print more. Backstop more. Promise more. We're now at $47 trillion in total system obligations, all sitting on a foundation of paper promises. This isn't just monetary policy. This is the final stage of a pattern that has destroyed every single reserve currency in history. And I can prove it to you using the Fed's own data. Here's what you need to understand. When central banks make mistakes this big, 3 things always happen. First, the currency devalues. Second, real assets explode in value. And third, the people who saw it coming build generational wealth while everyone else watches their savings evaporate into thin air. Silver holders are about to win big, not because of luck, because of simple math. By the end of this video, you will understand exactly what the Fed just did, why $47 trillion is the point of no return, and the specific reason silver is the single best asset to hold when this all unravels. I'm going to show you the pattern. And once you see it, you can't unsee it. Let me give you the framework. It's called the currency debasement cycle, and it has destroyed 775 fiat currencies throughout history. Every single one have followed the same 4 phases. Phase 1, trust. A new currency is launched, backed by something real, like gold or silver. The government promises to be responsible. Spending stays reasonable, and citizens trust the system. The US dollar entered Phase 1 in 1944 at Bretton Woods, with every dollar backed by gold. The system worked for 27 years. Phase 2, abuse. Something changes. A war, an economic crisis. The government needs more money than it has, so it starts printing, quietly at first. Nixon closes the gold window. The dollar becomes pure fiat currency, backed by nothing but faith. Phase 3, acceleration. The printing becomes obvious. Debt explodes. The central bank has to become the buyer of last resort because no one else will lend. We entered Phase 3 in 2008 with quantitative easing and 0 interest rates. The Fed's balance sheet ballooned from $900 billion to $9 trillion. And that brings us to Phase 4, collapse, confidence breaks. Foreign countries dump the currency. Inflation becomes undeniable and the central bank loses all control. Real assets go parabolic. This is where wealth transfers from savers to asset holders, not over years, but in a matter of months. The Fed just pushed us to the very edge of Phase 4. That $47 trillion mistake isn't just a number. It's the mathematical certainty that this currency cannot survive without being massively devalued. And when currencies devalue, silver doesn't just rise, it explodes. Stay tuned, because next I'll explain why silver specifically wins in Phase 4. Not gold, not Bitcoin, silver. Follow for more. Here's what most people miss when they think about precious metals. Gold is money. We all get that. It sits in vaults, it looks pretty, and central banks hold it. But that's pretty much the entire story. Gold is only money. Silver is different. Silver is money, and it's the most critical industrial metal of the 21st century. Think about it. Your smartphone, it's full of silver. Every solar panel on every roof, silver. Electric vehicle batteries, silver. Medical devices, 5G infrastructure, water purification, missile guidance systems, even AI data center cooling, it's all silver. There's no green energy transition without silver. None. The International Energy Agency admits this. The U.S. Geological Survey confirms it. Every serious study reaches the same conclusion. Solar panel production alone consumes 148 million ounces of silver annually. That's 14% of the entire global supply. EV production adds another 80 million ounces and is growing 35% per year. Now here's the problem. Global silver mining produces about 820 million ounces a year, but total demand is over 1.2 billion ounces. That's a 380 million ounce deficit every single year. We've had 4 straight years of these deficits, and 2025 is projected to be the 5th. We are consuming silver much faster than we can dig it out of the ground. And there's no easy solution. You can't just substitute silver in solar cells. The physics doesn't allow it. You can't replace it in electronics. Its conductivity is irreplaceable. So what happens when central banks' policies lead to currency devaluation? Investors will flood into hard assets. Gold will rise. Real estate will rise. But silver? Silver has a massive supply crisis layered on top of that monetary demand. That isn't just addition, it's multiplication. This exact pattern has played out before, creating generational wealth for those who saw it coming. Let me give you 3 quick examples. First, Weimar Germany in the 1920s. The government printed money to pay war debts, and the currency collapsed. In November 1923, $1 was worth 4.2 trillion marks. A wheelbarrow full of cash couldn't buy a loaf of bread. But people holding silver and gold preserved their wealth completely. The metal didn't change, the currency around it just fell apart. Second, the United States from 1971 to 1980. Nixon took the dollar off the gold standard. The Fed printed money and inflation soared. In those 9 years, gold went up 2,300%. But silver did even better, rocketing up over 3,400%. A $10,000 investment in silver became over $350,000. Third, modern Venezuela. The currency became worthless due to hyperinflation. A cup of coffee cost millions. But Venezuelans who had converted their money to silver before the collapse were able to secure their future, some even buying property abroad with metal they bought for next to nothing. 3 different countries, 3 different decades, but the same pattern every time. When central banks print excessively, currencies fail. When currencies fail, precious metals soar. And when precious metals soar, silver outperforms gold every single time. Today's central banks have made an unprecedented bet that this time is different. The math says they're wrong, and understanding why could be the most important financial decision you make. Thanks for watching, and be sure to follow for more. Let's apply the currency debasement cycle to exactly where we are right now. Phase 1, complete. The dollar became the global reserve currency in 1944 at Bretton Woods. Every central bank held dollars backed by gold. The world trusted American monetary discipline. Trade was settled in dollars, oil was priced in dollars, and for 27 years, the system held. Check. Phase 2, in 1971, Nixon ended the gold backing. And just like that, the discipline disappeared. The national debt in 1971 was around $400 billion. By 2008, it was $10 trillion. The Fed's balance sheet stayed under $1 trillion for decades. Then came the abuse. Quantitative easing, zero interest rates, bailouts. The printing accelerated. Check. Phase 3, we're deep in it, and it's speeding up. Look at the data from just the last 18 months. In March 2023, Silicon Valley Bank failed. The Fed responded with the Bank Term Funding Program, basically pretending their losses didn't exist. $400 billion was injected in just 3 weeks. By November 2023, interest payments on the national debt hit $1 trillion a year for the first time in history. We're paying more in interest than we spend on defense. Where does that money come from? They print it. The Fed buys the treasuries nobody else wants. Fast forward to today, and foreign central banks are dumping dollars. Japan, China, they're selling off U.S. treasuries. Who's buying? The Federal Reserve, with more printed money. Total Fed obligations, including all their promises and backstops, are now in the tens of trillions. Now, watch what's happening to silver during this phase. The physical market is screaming. COMEX registered silver inventories are being drained at an astonishing rate. Physical premiums in Asia are soaring. Dealers in Europe are reporting delays. The paper price might say one thing, but the physical market tells you the real story. And here's the number that should get your attention: the gold to silver ratio. Historically, it averages around 15 to 1. Today, it's over 80 to 1. That's a spring being compressed. When that ratio reverts to the mean, as it always does, silver doesn't just catch up, it overshoots. With gold at its current price, a return to the historic ratio implies a massive repricing of silver. Phase 4 isn't fully here yet, but we're standing at the door. The Fed has 2 bad choices: let interest rates rise and crash the economy, or keep printing and crash the currency. What do you think they'll choose? They will print. They always print. That's not cynicism, it's history. And when they do, math says silver is the single most undervalued monetary asset on the planet. The pattern is clear, and it is screaming. Thanks for watching. So, what's the game plan? First, you need to understand what's really going on. The Fed isn't making a mistake. They're making a strategic choice. They're choosing to devalue the currency slowly to prevent a sudden system crash. This isn't incompetence. It's a deliberate strategy. Your strategy needs to adapt. Stop thinking in terms of dollars and start thinking in terms of purchasing power. Dollars are just the measuring stick. Silver is the actual store of value. When you buy silver, you're not speculating. You're opting out of a system that's designed to transfer wealth from savers to debtors. And who is the biggest debtor in history? The US government. They need inflation. They need your dollars to be worth less tomorrow than they are today. Holding cash right now is like choosing to lose. Second, you need to buy physical metal, and you need to do it now. I'm not talking about ETFs, mining stocks, or futures contracts. I mean physical silver that you can hold in your hand. Why? Paper silver comes with counterparty risk. If the system's rules change, your paper could become worthless. If your ETF provider fails, you become just another creditor waiting in line. Physical silver has no counterparty risk. A coin in your safe can't default. This isn't about paranoia. It's about learning the lessons from every currency crisis in history. Right now, premiums are around $3 to $5 over spot price. When things really accelerate, expect those premiums to jump to $20, $30, even $50. Eventually, premiums won't even matter because there will be no metal left to buy at any price. Buy it now while you still can. Third, focus on recognizable forms. I'm talking about American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics. For larger amounts, think 10-ounce and 100-ounce bars from trusted mints like Johnson Matthey or the Royal Canadian Mint. Don't get distracted by collectible coins or fancy designs. You want pure silver content in a form that anyone, anywhere, will instantly recognize and accept. When the time comes to sell or trade, liquidity is king. Standard recognized products move fast. Obscure ones require explanations and discounts. Keep it simple and keep it liquid. Fourth, scale your investment appropriately. This is not about going all in. That's just gambling. This is about smart allocation. Consider putting 15% to 25% of your liquid assets into physical silver. That's enough to protect your purchasing power and position you for significant gains when the time is right, but it's not so much that you'll be ruined if things don't play out as expected. You need a plan that can survive any scenario, not just the most probable one. Balance your conviction with caution. Allocate, don't speculate. Finally, secure your assets. For smaller amounts, a good home safe will do. For larger holdings, look into a private vault. It's also wise to diversify your storage locations. Don't keep all your eggs in one basket. And please, avoid bank-safe deposit boxes. In a crisis, banks can close and governments can freeze assets. You need access to your metal precisely when institutions are at their least reliable. The whole point of physical silver is to eliminate counterparty risk, so don't reintroduce it with a poor storage choice. Thanks for watching. Be sure to follow for more insights. The window is closing, and it's not because of some guru's prediction, hype, or a wild conspiracy theory. It's closing because of simple math. The Federal Reserve just effectively backstopped $47 trillion in obligations with its printing press. At the same time, the interest on our national debt has soared past $1 trillion per year. Foreign buyers are ditching U.S. treasuries at a record pace, and the COMEX vaults, which store physical commodities, are draining at a rate we haven't seen since the 1980s. Every single one of these data points confirms the same pattern, and every single historical precedent points to the same outcome. When currencies die, they die fast. Venezuela went from a stable economy to people hauling wheelbarrows full of cash in just 3 years. The Weimar Republic went from normal to trillion-mark bills in only 26 months. Once public confidence breaks, it breaks completely. We're not there yet. But the final phase of this cycle doesn't announce itself with a press release. It arrives when everyone suddenly realizes the emperor has no clothes. You want to be positioned before that moment. Not during, and certainly not after. Before. So here's my question for you. Are you going to wait until silver is $100 an ounce and wish you had acted sooner? Until premiums are $50 and dealers have 6-month waiting lists? Until the Fed finally admits what the market already knows? Or are you going to recognize the pattern, trust the math, and position yourself while this window is still open? The choice is entirely yours, but that window won't stay open forever. The Fed just guaranteed it. If this made sense to you, if you see what's coming, subscribe to The Silent Economy right now. Because what I've shown you today is just one piece of a much larger puzzle. The Fed's $47 trillion mistake connects directly to the commercial real estate crisis, the regional banking collapse that's still unfolding, the derivatives market with its $600 trillion in notional exposure, and the treasury market losing its foreign buyers. It all follows the same currency debasement cycle. It all points to the same conclusion. And it all benefits the same asset class. In my next video, I'll show you the specific trigger that could accelerate this final phase from years down to months. I'll reveal the one chart that tells you exactly when to expect the break, and the strategic moves you need to make before it happens. Subscribe, and watch the next video to learn what's coming. Because people who see the pattern early don't just survive, they thrive. They don't just protect their wealth, they build it. Throughout history, 775 currencies have failed. The US dollar will be number 776. The only question is when. And the Fed just gave us a huge clue. The clock is ticking, the vaults are draining, the math is undeniable. This is the silent economy, and now you know what's coming.